How Russian-Ukraine conflict might hit global markets. The global market has just been reviving as the graph started to show growth. But all of this was put to a halt. There is a potential threat lurking at the outskirts of Eastern Europe. The Russians are preparing their military at the border of Ukraine. Even though the Russians may have denied any plans for an invasion, and it was normal for the behavior, but recent stationing of troops and their actions are speaking louder than words, and 100,000 troops positioned at the Ukrainian borders might just mean otherwise. When we speculate these sort of geopolitics and their effects, the market does drop, but it might not be the case, as if Russia cuts off supplies to Europe, there would be the US and other countries aiding Europe in the crisis. The prices would increase, but in a lower magnitude. But Russia is huge on oil production and natural gas output. Most of it goes to Europe, and cutting it off would not be a smart move for them. But if they do, the traders and investors might want to think about this. Hi there, come with us as we speculate the effects it might have on the market and decipher the market's direction so that we can invest better. And if you like the content like this, then do not forget to subscribe and ring the bell beside it. This would make sure that you get notified as soon as we upload a video and help you stay ahead of the game. Russia's deputy foreign minister compared the current situation to the 1962 Cuban Missile Crisis, when the US and Soviet Union came closer to a nuclear conflict. Even though activities like this have been normal, the US officials say that Russia has not been able to explain the reason why there are Russian troops stationed in the borders of Ukraine. This is concerning, not only for Ukraine but for the entire world. Could this be the start of a world war? Let's hope not. As with the way Russia's deputy foreign minister compared it, it might seem like it, but well, let's keep our fingers crossed and hope it won't happen. Well, if the invasion does happen, let's see how the markets respond. Unpredictable. We do not know the intentions of Russia. As I researched, I found that Ukraine is divided into two parts, which are Western Ukraine and Eastern Ukraine. Western Ukraine does not like the Russians, but the Eastern Ukrainians are on the side of the Russians. Eastern Ukraine expressed to the Ukrainian government that they do not want to be part of NATO. But after the invasion and annexation of Crimea, they changed their minds. Now the Russians would not like the Europeans sticking noses, so they have stationed troops at the borders. The activity has increased over March and April, but we can say it is normal to an extent in efforts to remain positive. But there could be triggers that could motivate the invasion, such as a sanction between that would not be in the best Russian interest. Or maybe if there are more US troops stationed, the Ukrainian borders could trigger the Russians, leading to an invasion. Nevertheless, this will heavily affect the prices of natural gas, as Russia is the largest natural gas exporter to Europe, and they could shut the pipelines off. If the officials allow sanctions on Russia, then they could stop the supply of natural gas as a form of retaliation. Well, even if it is just a false alarm and there's no invasion, Vladimir Putin has managed to put a dent in the Ukrainian economy. Rapid building of Russian troops at the borders could be felt on the graphs across multiple markets, mainly the energy and wheat prices. This strikes a fear on the investors, as it would result in a drop in stock prices and surge in commodities, therefore posing a risk to the investors, and they would start investing in bonds. And they are the safest investments on the planet. Or gold, which is already at a 2-month peak. The Russian invading Ukraine would mean an increase in oil prices, which could lead to inflation. The European gas prices would surge even more if the Russian troops enter across the border to Ukraine. America's regional head, Mr. Padraig Garvey, said, "Clearly, if Ukraine's story was to go wrong, there would be quite a significant bid for treasuries, and this notion of the 10-year getting a 2% would be put on hold." Food inflation. If the invasion does happen, Ukraine is the world's third largest exporter of corn and also the largest exporter of wheat. The invasion would disrupt the flow of grain output through the Black Sea region, and that would have a major impact on the prices and cause food inflation at a time when affordability is a major concern, as the global pandemic has put a huge dent on the economy on a global scale. This means the prices would rise and hence affect a lot of companies, and this has kept investors at the edge of their seats. A strategist at UBS, Mr. Dominic Schneider, said, "Geopolitical risks have risen in the recent months in the Black Sea region, which could influence wheat prices ahead. Natural gas and oil. In 2020, the pandemic suppressed the demand for natural gas and oil in Europe, but as the demand abruptly surged, the tanks were not enough, leading to a gas crisis. This in turn launched the prices off the charts. If Ukraine does get invaded by Russia, then the approval process to a pipeline network said to import natural gas from Russia, namely the new Nord Stream 2, could be halted, resulting in a further increase in the prices. Energy markets are at risk as Europe relies heavily on Russia for natural gas, as said by SEB Commodities. Analyst Bjorn Schildrop said, markets should see natural gas exports from Russia to Western Europe to be significantly reduced both through Ukraine and Belarus in the events of sanctions and gas prices by the end of the year. Oil markets could also be affected. As said by JP Morgan, the tension risked a material spike in oil prices and noted that a rise to $150 per barrel would reduce global GDP growth to just 0.9% annualized in the first half of the year, while more than doubling the inflation to 7.2%. Regional dollar bonds and currencies. Military actions could be taken as the Russian and Ukrainian assets would be at the forefront of any market. There have been escalating tensions between Washington and its allies in Moscow, which was the reason why the investors trimmed their exposure to the Russian and Ukrainian dollar bonds. Ukraine has a fixed income market, and it has proven to be a remit for emerging market investors, while on the other hand, Russia's overall approach on capital markets has made them shrink in these recent years amid sanctions and geopolitical tensions, somewhat saving them from any threat of contagion through these channels. Geopolitics on the Ukraine-Russia border presents substantial uncertainties to foreign currency markets, as said by Chris Turner, the global head of markets at ING. He also said that the events of late 2014 remind us of the liquidity gaps and US dollar hoarding that led to a substantial drop in the ruble at that time. In the world of markets, Russia's ruble and Ukraine's hryvnia have also suffered, making it the worst performing currencies this year. If the tensions at the border between Russia and Ukraine don't ease, then the world's share market could drop on an exponential level. As the Russians stack their forces at the borders of Ukraine to strike a potential invasion, the markets have been dropping and investors are facing a huge amount of loss. The markets have just started recovering from the global pandemic, and with the conflict, it has been stagnant. The invasion is likely to result in inflation and a huge drop on the market. If you found this video helpful, then show us by liking the video. You can also share it with your fellow investors. That would be a great help to them. Comment your thoughts about the Ukraine-Russian conflict and your market, and we'll see you next time.